For 140 years, this enterprise has defined global premium manufacturing. It is a heavy industrial behemoth that produces and ships roughly 2 million highly complex mechanical and electronic units every single year. Yet today, Mercedes-Benz Group, trading under the ticker MBGAF, can be bought on the public market for about $59 a share. At that price, the market valuation completely detaches from the company's actual operational output. This is a business that currently generates over 5 billion euros in free cash flow annually. This diagram illustrates the resulting price-to-book ratio. At $59, you are paying a multiple of 0.53x, a figure that sits far below the bottom of the company's own 5-year historical range. A 0.53x price-to-book ratio carries a very specific mathematical implication. It means investors are currently valuing the ongoing operational business at roughly half the liquidation value of its physical assets. The analytical problem is straightforward. How does a global franchise that literally invented its product category and still prints billions in cash get priced as if its underlying business model is permanently broken? The math suggests a definitive market consensus. Investors have entirely priced in a state of irreversible margin decay and the eventual extinction of the franchise. To test that extinction narrative, we have to contrast the market's pricing with the reality of the internal balance sheet. This chart compares their total equity value against their liquid reserves. Mercedes currently holds a net industrial cash position of 33.8 billion euros. That specific cash pile actually grew sequentially in the most recent quarter. A company actively building its reserves contradicts the narrative of an operation burning through capital to survive. Furthermore, their debt structure is heavily insulated. The company maintains an interest coverage ratio north of 77x on an EBITDA basis, meaning their operational earnings could collapse significantly before debt servicing becomes an issue. Behind that, they hold an untouched 11 billion euro revolving credit facility acting as a dormant, ultimate backstop. With this level of liquidity, the typical mechanics of corporate failure break down. They face no financial maintenance covenants on their primary credit facilities, making forced dilutive equity raises or debt-driven death spirals mathematically impossible in the near term, and solvency here is an absolute certainty. Therefore, the depressed $59 share price is not pricing in an immediate existential threat. It is purely a reflection of extreme market pessimism regarding future operating margins. We can reverse engineer the exact math the market is using to justify that $59 price by feeding the inputs into a discounted cash flow model. First, the model requires the enterprise's EBIT margins to be dialed down to a permanent 4%. Second, top-line revenue must permanently stagnate at $120 billion, assuming no future pricing power. Finally, the terminal growth rate must be set to exactly 0. It is a dual expenditure burden pure-play tech competitors avoid. Third, new international trade tariffs introduce a direct 150 to 200 basis points of margin drag entering 2026. This is real capital being actively diverted away from the bottom line. If you believe these regional headwinds and dual platform transition costs represent a permanent impairment of the franchise, then the DCF inputs are correct, and $59 is a perfectly rational price. This graph plots the timeline of its capital expenditures. To dismantle the narrative of permanent decline, we have to look at the internal levers management is pulling. Management has structurally front-loaded its transition costs. The massive checks required to build proprietary operating systems and modernize factories officially peaked in 2025, with scheduled declines through 2027. Because of the mechanical inverse relationship between the two, as capital expenditures fall, free cash flow mathematically expands. This creates a highly advantageous setup. The enterprise does not need a sudden surge in top-line revenue to generate more cash. It simply needs the investment hangover to clear. That cash flow expansion is being accelerated by a second internal lever, an aggressive, tightly audited cost reduction program. This is not a theoretical slide deck exercise. The company pulled in 3.5 billion euros in realized audited savings in 2025 alone. Their remaining target involves pulling forward a full 5 billion euros in cost reductions by the end of 2026. Crucially, this involves a targeted 20% reduction in variable and fixed costs specific to the challenged Asian markets, driven primarily by localized sourcing to bypass trade friction.
Maintaining 33.8 billion euros in net liquidity while executing billions in restructuring during a profit collapse requires aerospace-grade treasury management, led by CFO Harald Wilhelm. The combination of structurally falling capital expenditures and heavily enforced cost-cutting programs guarantees a mechanical expansion of free cash flow in 2027. This happens completely independent of whether external macroeconomic conditions improve. The final variable, and the most critical for the value investor, is how the enterprise allocates that mechanically expanding cash flow. This diagram shows their active €2 billion share buyback program.
The company is using pure operational cash flow to hoover up its own stock at the depressed 0.53x book value. Over 5 years, this engine has retired 10% of the total outstanding share count. Because these shares are continuously purchased below their liquidation value, every retired share mathematically increases the tangible book value of the shares that remain. Furthermore, the governance structure actively protects this accretion. Mercedes has zero stock-based compensation dilution. Management utilizes cash-settled phantom shares under IFRS accounting standards. This means your percentage of ownership is never quietly chipped away to fund executive payouts. CEO compensation is directly tethered to EBIT and free cash flow performance. When the business cycle hits a trough and earnings contract, executive pay drops alongside it, perfectly aligning leadership with the equity holders. By aggressively buying back stock below tangible book value, funded strictly by operations and protected from dilution, the company ensures pure equity accretion for the patient investor. Ultimately, analyzing this asset requires distinguishing between a hope-based catalyst and a self-help catalyst. A macro rescue, such as stabilizing Asian consumer markets or a sudden reversal of trade tariffs, would certainly turbocharge a recovery. But those external forces are not requirements for survival. The core internal realities are already in motion. The capital expenditure peak is behind them, audited cost savings are hitting the income statement, and total ownership is being heavily concentrated at distressed valuations. The true threat to this thesis isn't insolvency. The risk is that a complex, multi-year product transition bleeds into a decade-long quagmire of operational delays, locking up capital for years. At $59, the market is making a definitive bet on a permanent structural decline. The €33.8 billion balance sheet proves the enterprise has the fortress required to navigate this transition entirely on its own terms. An enormous amount of extreme pessimism is already perfectly priced into the asset. The investment thesis now rests entirely on one question: whether management can convert this product supercycle and cost restructuring into actual margin recovery before the market loses patience.